Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about the landscape, lending landscape that is, and how it's changed so much really since I started Pro Solution back in 2002. And I'm loath to mention that because obviously people are just going to roll their eyes and think, oh my God, how old are you? Which the whole team here tell me or remind me at least a few times a day. I've got an important item before we jump in today's episode. For the very first time, Campbell and I are doing a live Investopoly Q&A episode on YouTube. It's on Monday the 23rd of March at 8:30 p.m. Melbourne time, and we're going to make it interactive. We've got some great questions, case studies that we'll be discussing, and you can ask questions live and we'll have a go at answering them. In fact, Campbell and I won't even compare our answers to these questions and case studies before the event, so you'll see our conversation live and how we bounce ideas around. To register, go to investopoly.com.au/live. The link is in the show notes. Anyway, it's really important to really understand the lending landscape. And I wrote a book a few years ago called Rules of the Lending Game. And the reason both books, Investopoly and Rules of the Lending Game, are kind of play on, board games, of course. Rules of the Lending Game being sort of snakes and ladders. But the thesis behind it was that, really investing, and particularly investing or specifically investing in property, is really a game of finance because the scarce resource is not investment grade assets. The scarce resource is borrowing capacity. And last year, I recorded an episode around return on borrowing capacity, just really trying to encourage investors to really think about borrowings as an asset. And therefore, you want to allocate that asset most efficiently. So, if I think back to 2002, when I started the business, lending landscape was miles different to what it is today. I mean, essentially, if you could fog up a mirror, you could borrow whatever you wanted to borrow. And the rules were pretty loose back then, but they're being tightened substantially. And yet again, over the last couple of years, the landscape has changed. So I think if you're, closer to the beginning of your investment journey, rather than closer to the end of it. So in terms of if you're at that acquisition stage, this is going to be really important for you to understand how the lending landscape has changed. So let's start with a little bit of a lesson around lending and regulation and those sorts of things to begin with, because this is where it really starts in terms of understanding that landscape. And really, there's bank and non-bank lenders, and that's just not a brand name. There's actually, some regulation and legal requirements behind the definition. So the first one are banks, right? So traditionally banks, what they do is they accept deposits from customers. You put the money in the bank and you want to earn some interest, particularly if it's a high interest account. If it's just a traditional bank account, you're not earning very much interest at all. Anyway, that's how the banks get money. And then obviously they need to find something to do with that money, as in invest it so they can afford to pay you interest. And so what they do is they lend that money out through mortgages. And so banks, to use the name in the name bank, you have to be what's called a authorised deposit taking institution. So an ADI is the acronym for short. And because, the government, every government of a developed country wants their banking system to be robust, and they don't want their citizens losing money by putting money in the bank. It's supposed to be a safe place to put it. It's highly regulated. Banks are highly regulated, and they're regulated by the Australian Prudential Regulatory Authority, APRA, another acronym. Plenty of acronyms in today's episode, by the way. So a bank that's an ADI that takes deposits, if you go and borrow from a bank, there's going to be greater regulation. And that's why there's greater regulation. It makes sense, right? That's exactly what we want. If we've got people putting their savings in the bank account, it needs to be safe. Now, during the GFC, the Australian government decided to introduce an Australian government financial claims scheme, which essentially means the government guarantees up to $250,000 per account holder. So in other words, if a bank is to fail, and the government's going to guarantee the first $250,000. And that's why sometimes you see people, if they've got, say, $500,000 of savings, they might spread it across two banks so they get that government guarantee. Look, it's good, the government guarantee, but, some Australian banks are some of the safest in the world, particularly large banks. So I don't really think you're moving that risk dial very much by spreading your money across institutions. So that's banks and that's bank lenders. let's talk about non-bank lenders now. So non-bank lenders typically don't fund their money through deposits. So in fact, because they're not a bank, they're not an ADI, they actually can't take deposits. And so how a non-bank lender will lend money is through what's called mortgage securitisation. Now, it got a bit of a bad name during the GFC. It was certainly misused overseas in the US. It wasn't misused in Australia. But the banks don't really do much in terms of mortgage securitisation. It's really the non-bank lenders. And so essentially what happens is I get a wholesale facility, maybe $200 million, and I will use that to fund mortgages. It might be 500 million, whatever the number is. Once I've funded those mortgages, I will bundle them up and then go and sell them as a bond to the market. So they're called mortgage-backed securities, and investors will buy those bonds because they want an income stream, of course, an interest income stream. And La Trobe is probably the biggest one that does this. There's plenty of similar sort of lenders. But the point is that because they don't take deposits, they're not regulated by APRA. They're regulated primarily by ASIC, and the main sort of legislation that covers what they do is the Corporations Act and the National Consumer Credit Protection Act, or NCCP. There's another acronym for you, which we'll be talking about in a second. So how a lender funds their mortgage is really important, particularly around interest rates, interest rate sensitivity, credit policy, and it can be a positive or negative, by the way. I mean, if we're dealing with a client that we know that's a little bit unusual, but we know they're very low risk, we will go to a bank typically to try and get that mortgage set because they're a balance sheet lender. They don't need to worry about securitization. They've got more flexibility around credit policy about what they want to do or not want to do. Whereas a non-bank lender is going to be more rigid because the mortgage needs to comply with certain parameters in order for them to be able to bundle them up and sell them together. Because essentially what they do is they bundle up mortgages with the same kind of risk profile and sell it to the market. So they'll have a bundle of very low risk mortgages, a bundle of higher risk mortgages, for example, and they'll have to pay more on the higher risk mortgages and obviously charge more for those mortgages as well. So coming back to regulation, I spoke about the National Consumer Credit Protection Act, NCCP, which is what I'm going to call it. NCCP covers what's called regulated lending in Australia. Regulated lending is lending for home and investment purposes. And I know this seems a bit dry, but stay with me because it's really important, again, to understand the rules of the game, to navigate it from an investor's perspective. So by contrast, commercial lending, which could be lending for, to buy a commercial property, lending to fund a business, or could be as simple as lending in a company name or a trust name, is not what's regarded as regulated lending. So it doesn't need to comply with the NCCP framework. And you might think, okay, well, that gives me less protection. But in some situations, you might not necessarily want to use a lender that needs to comply with NCCP because it might be a bit of an unusual circumstance and you want to kind of navigate the obligations that are contained within that legislation. So what does the NCCP Act require in terms of those obligations? And again, it's important to understand what a lender has to do by law, because if you're going to have an argument with them in terms of whether they should approve a loan and they're saying, no, we have to do this by law, you're not going to win the argument, of course. So the first thing is that lender needs to hold an Australian credit license, just like mortgage brokers do. Mortgage brokers either have to, we have an Australian credit license, or they've got to be authorised under one. They've got to provide pre-contract disclosures. So that's really key terms of the loan. They've got to make sure that the loan is affordable and suitable. So they've got responsible lending obligations. They've got to deal with hardship fairly. So that's if, you're struggling to make repayments. They've got to belong to an external dispute resolution scheme. AFCA, AFCA, there's another acronym for you, is the common one. I think pretty much everyone belongs to AFCA, including ProSolution. And they've got to act honestly and efficiently and avoid unconscionable conduct. I mean, that's just a general overarching requirement in the Corporations Act. So really, if you're dealing with a lender that has to comply with NCCP, they've got to be upfront about their disclosure around the terms of the loan, fees, interest rates, all those sorts of things. And also, you've got the fallback of an external dispute resolution. So you can go and complain to AFCA if you do run into any trouble. These are important things to really think about. So that's the legislation they have to comply with. What they don't have to comply with is on the Prudential side. So because non-bank lenders aren't ADIs, they don't have to follow APRA's macroprudential lending settings. So things like the 3% buffer, which is that banks have to add 3% on top of the current interest rate to test whether you can actually afford the repayments at a principal interest basis, even if you're borrowing on interest only. Non-bank lenders don't need to comply with that. Recently, at the end of last year, APRA put some caps on high debt to income lending. Non-bank lenders don't need to worry about that. A few years ago, it's 5 or 6 years ago now, or maybe even 7, the APRA put a cap on interest-only lending, for instance. Non-bank lenders don't need to worry about that. So you'll see this talked about in the news in terms of APRA tightening the screws on credit policy, but that only applies to ADIs or banks. Now, quite often we get asked, particularly if we're recommending a non-bank lender, their brand names might not be as, people might not recall their brand names or be aware of their brand names as much as ANZ, NAB, etc., etc. And so quite often we get asked, is it safe? Well, I'm not going to sit here and say every single non-bank lender is no problems. Of course, there's always going to be bad apples in any industry, or, businesses that promise a certain level of service or whatever and don't and fail to deliver that. So there's always going to be good and bad lenders, but there's plenty of really large lenders that have been around, non-bank lenders that have been around for a very long time, longer than I've been in business, that have runs on the board. And the big non-bank lenders the big four are really Pepper, Liberty, Resimac, and First Mac. Now, there's non-bank lenders that fall outside of that. The key thing to understand is, firstly, how long have they been around? Have borrowers had experienced poor outcomes previously? And where are they getting their funding? Because quite often, those big four that I just mentioned will provide what's called white label products. So if I wanted to establish Pro Solution home loans, for example, I could go and establish a relationship with them and they would really be the lender and I would just badge the product, if you like. So there's a lot of those sorts of non-bank lenders out there. It's really about looking under the hood and seeing who am I dealing with and what are the experiences. But a good mortgage broker, that's been around for a long time will understand who's who in the zoo and will be able to sort of point you in the right direction. Now, the big difference between bank and non-bank lenders is offset accounts. Remember, a non-bank lender is not a deposit taker, so it can't offer you a traditional offset account. However, some non-bank lenders do advertise that they have an offset feature. And essentially, the way that they deliver that is really by using kind of a sub-account structure, where you've got one account, one sub-account that's in debit, meaning you owe them money, that's your mortgage, and one sub-account that's in credit, which is, in inverted commas, your bank account. And so when interest is calculated at the end of each day, they obviously net off the credit account off against the debit account and you'll charge interest on the difference, just like you would if you had a sort of normal offset account with a bank. So another way of describing it is really just quarantining extra repayments. Instead of actually reducing the loan amount, we're just sort of quarantining that any sort of extra repayments in a separate sub-account. Now, if that non-bank lender fails, they're going to be entitled to offset the debits against the credits and your cash in offset will disappear or could disappear. They will use it or they could use it legally to reduce the debt that you owe them, as opposed to an ADI that benefits from the government guarantee. If they ran into any trouble, arguably or most likely is that the two different products would remain separate, whereas you've got the mortgage and then you've got your deposit or your cash. So it's important to understand how offsets in inverted commas behave with non-bank lenders and just make sure that it's going to be appropriate for your circumstances. If you want a fully functional transaction account as an offset account, that's probably not your thing. If you have a strategy where you've got debt but a large amount in offset and you would always like that to be the case, then maybe a non-bank lender might not be perfect for you. That is to say that there's some residual risk that if they do fail, that that your loans will be automatically repaid with the offset monies. And look, that could happen. That they do have offset clauses in bank mortgage terms and conditions as well, but it's just less likely, I think, with a bank. Look, these aren't big risks, by the way. Again, if you're using a robust non-bank lender that's been around for a long time, that has a good reputation, I think the risk is pretty low. But something we need to mention, Macquarie ran into a bit of trouble in terms of funding its mortgages through the GFC and hiked interest rates and so forth. So even a lender with a brand name like that and a strength like that, things can go awry. Okay, so what are some of the downsides before we talk about what are the advantages? What are some of the downsides with using a non-bank lender? So the first thing is that non-bank lenders don't really have a branch network. Look, some might have arrangements with other banks, so you might be able to use NAB branches, for example. But really, at the end of the day, if a face-to-face access matters to you, then maybe a non-bank lender is not going to be the right solution. That said, for anyone that's been into a branch lately, it's not something that anyone would ever forward to doing. That's an absolute nightmare. I had to transfer some money for a settlement a few years ago, and literally I was in the bank for 2.5 hours. A really basic transaction. Anyway, I'll get off my soapbox. The second thing is, apart from branch networks, relationship networks are different as well. So we deal with some banks, private bank or other parts of first party within banking structures where they'll provide our clients with a person to look after their situation on a day-to-day basis. So, if you have a problem with your credit card or you want an account set up or query something, you've got an individual to go to. Of course, non-bank lenders don't provide that sort of personal service. So again, you're going to deal with a call center. A lot of things can be done online these days, particularly with a lot of these lenders, which streamline things. And frankly, I'd rather deal online with a bank. But again, if you're looking for that more personalized arrangements, it's not going to work for you. And lastly, interest rates can move independently of the RBA. Remember, I said that non-bank lenders fund mortgages through securitisation, and securitisation is just a subset of the bond market. If bond market expectations move, that means the cost of funds increase. The lender could then pass on those cost of fund increase to you. So but the bond market is really influenced by expectations, future expectations. So if the bond market price is in 100% chance of an RBA hike next month, the cost of funds could rise, and then they could end up passing that interest rate increase onto you even before the RBA's hiked interest rates. Now, it doesn't happen that often because there's competitive pressures, right? They need to remain competitive, and if the whole market hasn't raised interest rates, they don't want to either. But it can happen. And again, the GFC, although it's 15 whatever years ago, a long time ago, it can happen. Cost of funds moved, and again, the Macquarie example, Macquarie increased interest rates substantially more than RBA throughout that cycle, and that was an issue. Now, again, it's not the end of the world. Potentially, it's not the end of the world because you could refinance, which is what happened a lot during the GFC, and banks were happy for that to take that non-bank lending back and get it back on their books. But if you're stuck there, if you can't refinance, then that's a bit of a challenge. Now, again, none of these things are major risks. It's really just pointing out the differences rather than it being absolute deal killers, because you're going to use non-bank lenders, to my mind, or at least we do, in a different way to banks. And it's just part of the suite, which I'll talk about in a second. Okay, now finally, let's talk about the advantages. The advantages of borrowing capacity and substantially higher borrowing capacity. If we think back over the last 5 to 7 years, there's been an incredible amount of tightening as a result of APRA tightening Prudential regulation. And so the gap between what a non-bank lender will lend and what a bank lender will lend, not in every scenario, but in many scenarios, has widened significantly, particularly the 3% interest rate buffer, the focus on living expenses. They're really the two things that have widened the gap the most, I think. So, for instance, the team was working on a situation literally last week where we looked at borrowing capacity across all the banks, and we worked out that this client could borrow an extra $600,000. And then we looked at a non-bank lender, and additional borrowing capacity was as high as $1.2 million. It's twice as much in terms of additional borrowing capacity. Now, I'm not saying that we should arbitrage lenders and just work out and always borrow, if we find a lender in Australia that's willing to lend to us. It's not about going out there and just maximising borrowing capacity. In fact, in this podcast, I've spoken many times about having a more balanced approach and a prudent approach. That we must ensure that not only is it affordable, given where our current circumstances are and how we think our circumstances might change over the next few years, but also whether it's appropriate for the strategy. So I'm not sitting here advocating that people should just borrow to their eyeballs, but there's more situations today than there was, say, 10 years ago, where we would sit down and go, no, that's affordable. Someone, you can go and buy a investment property for $1 million. That's very affordable given your, cash flow position, equity position, and it's appropriate for your circumstances. But because maybe some uniqueness of their situation or because of just general tightening and borrowing capacity, we might find it difficult to find a lender that's willing to lend that amount. So that's unique because 10 years ago, I would say almost always, or at least more than 90% of the time, banks would lend way more money than what would be prudent to borrow. Well, that's not the case today. Now, as I said at the beginning, investing in property is really a game of finance. Again, if I can get more borrowing, so if I go back to the situation of 1.2 borrowed from a non-bank lender versus 600,000, I'm going to get two very different properties for those budgets. And by borrowing, assuming it's safe and it's affordable and prudent, all those sorts of things, if I go and borrow $1.2 million, chances are not only have I invested more sooner, so I get to benefit from that compounding capital growth over a long period of time, but I'm hopefully buying a much higher quality asset as well, which reduces my investment risk because the chance of achieving a benchmark return of 7%, 8%, 10%, whatever it is much higher. And also because I'm buying a higher quality asset, hopefully over the long run, on average, my capital growth rate is higher as well. Now, non-bank lenders can be slightly more expensive. And we're not talking about cheap stations here, but there could be 0.1, 0.2%. But I'd much, much rather pay an extra 0.2%. Let's remember it's tax deductible. So really the higher interest rate is really half the cost after tax deductions. I'd rather pay a slightly higher interest rate to get a better quality asset and to invest more sooner than be too ultra focused on interest rates at the expense of, the asset quality and ultimately long-term compounding returns. And also, let's put this in context. I'm not marrying the non-bank lender. It's not like I've got to be there forever. I might use a non-bank lender to get into the market. And then if I am paying a slightly higher interest rate, I might go back and negotiate with them to see if they will match. And if they won't match, I could always refinance in a couple of years anyway, when borrowing capacity is less sensitive to, my plans or what I'm looking to do. So really, in the order of importance, as a borrower, and particularly as someone that is in the early stages of wealth accumulation, so that is, I'm in the acquisition stage, my goals are firstly to maximize my borrowing capacity where appropriate. And then secondly, once I've done that, then to minimize borrowing costs. But don't confuse those two priorities because, as I said, by using certain lenders in certain order or by using different lenders, if it gets you into the market sooner, if it helps you buy a higher quality property, if it helps you invest more sooner, all those things will be worth a lot more in terms of wealth accumulation over the next few decades than a small differential in interest rate. Now, because non-bank lenders have a different approach to serviceability, quite often what we will do is exhaust or utilize borrowing capacity with a bank first. Now, let me give you an example. So we might go and buy a home, for example. Okay, so the clients go and buy this forever family home. They need to borrow a substantial home loan. We might do that through a bank. And then as a few years might pass, they're sort of on top of the home loan repayments, they build a bit of equity in that property. The next point of call might be then an investment property. If we go back to the bank might say, yeah, well, look, we'll give you a deposit, but now your overall borrowing capacity is actually going to limit the purchase price of the investment property. So in that situation, we might get access to enough equity to use as a 20% deposit against their home and then borrow the remaining 80% from a non-bank lender because they've got a higher borrowing capacity. So in that situation, we don't need to worry about offset accounts. We don't need to worry about banking network. We don't need to worry about any of that sort of stuff because it's really a set and forget loan, the investment loan. We're not really going to worry about it. We're not going to probably focus on extra repayments or any of that sort of stuff. So we can have a no-frills product for that part of the lending because we've already got sort of the normal banking network for the home and the deposit loan for the investment property. So there you go. I just wanted to present this episode today because it really is a changing landscape. And it's really important to understand. I mean, it's always been important to understand the rules of the game in terms of credit policy and how banks fund loans and how they approach credit decisions, all those sorts of things. But there's just such a wide gap now. And literally, I gave you the example of 600 versus 1.2 million. That's not an outlier. That's a regular situation that we see more and more. And so it's really important to work with a great mortgage broker that understands investing, understands the key parameters in terms of maximizing valuations, maximizing borrowing capacity, maximizing someone's ability to invest, where it is safe and prudent to do so, is ultimately going to be the thing that's going to help them achieve success, because at the end of the day, the quality of the assets that you invest in over a very long period of time determine the outcomes. And if you can get yourself into a position where you can safely acquire a higher quality asset, well, you'll look back in 10, 15, 20, 30 years and go, that was a no-brainer. That was a good outcome. Okay, let's get into a question. I reckon I can fit one question in. This question's from Samantha. So, Samantha, what would you recommend for asset-rich but cash flow poor individuals? So just a bit of rundown. They're both 38. Salaries 125,000 each year. 125,000 each week. Each year, of course. 400,000 in super, high growth industry super funds. One child, primary school age, won't go to private schools. So don't need to worry about private school fees. 320,000 in shares, mostly ETFs, and surplus cash flow, about $40,000 a year. They'd like to buy a family home in 5 to 10 years and will need about another $1 million in order to do that. They're quite happy with their net worth, about $3.3 million, and it's growing about $250,000 a year in terms of net worth, but they feel under-leveraged and they think they can probably improve on leverage. And they're just wondering what I would do in their situation. So they're tossing up putting some gearing into super. So they've got 800,000 in super. So go buy a house for 1.3, for example, establish a self-managed super fund, put some borrowings in there, additional salary sacrifice into super, forget about property and super and just save the $40,000. And the fourth option is move to Milan and buy a Ferrari. Well, I'm not sure about Milan. I'd probably prefer Florence, and I don't think I'd ever drive a Ferrari. But anyway, we can probably discount that option. And so the questions, should they buy an investment property in super? What would I do? And if an investment property is on the cards, is 1.3 enough for an investment grade house in Melbourne? So in terms of their property portfolio, they've got a home, which is ostensibly no debt, worth $700,000. Worth $1.4 million. The loan's fully offset, and they've got 3 investment properties worth about 2.8 million, with about 1.3 of debt, with about 200 in offset. So really net debt of 1.1 against 2.8, with about 70,000 of gross rental income per annum. So they are in a pretty good position, or maybe even very good position. You could, on paper, this is really interesting. On paper, adding some more gearing and buying a house in Melbourne, 1.3 should be enough to get a decent standalone house. It might be on the northern side of the city, but that's no big, still investment grade, could work really well for you, especially on paper. But would I do it? The approach, no, I wouldn't do it. I'm asking myself why. While on paper it would work. On paper you could sit there and justify that I think this is a good idea. And this is kind of interesting. So why don't I think it's a good idea? Well, it's not necessary, firstly. And secondly, you then have too much in property. So let me explain that. It's not necessary because the whole point of investing, and the whole point of investing in property, hopefully, is buy an asset, never sell. Hopefully, you just benefit from that compounding capital growth. But we have to realize that, firstly, when we first start investing in property, we don't begin with perfect knowledge. So it's possible that, and it's likely that we make mistakes along the way, which means that when we look at a investment property portfolio, normally there's one asset in there that we wouldn't have otherwise bought again, knowing what we know today. So there's that element that, that doesn't mean you should hang on to it irrespective of, performance and outcomes and those sorts of things. So I think that you could probably get towards buying that home by crystallizing some of the equity that you've got in your investment properties. And there's one there that has a lot of equity, but you just choose the one that you think had you were least optimistic about its future returns. If you were equally optimistic about every property, well, okay, then maybe we've got a bit of a challenge on our hands. But normally there's one in there that you go, it's a bit of a pain in the neck, or it's not growing as fast, or we're not as optimistic about it. And then the whole point of investing is to help us achieve our goals. One of those lifestyle and financial goals is retirement, but there's also financial and lifestyle goals that occur along the way before we get to retirement. And upgrading a home could be one of them. So as long as you've got a good long-term plan on how you're actually going to fund retirement, so you don't make these decisions irrespective of their impact on your long-term retirement ability. But as long as you've got a long-term plan, it's okay to potentially sell an investment property to fund a home upgrade. That's the whole point of investing in the first place, so that you can kind of enjoy some of the fruits of that labor while you're going through that investment journey, rather than waiting until you're 60 or 65 to start sort of enjoying those outcomes. So that's why I don't think it's necessary for you to do it. And secondly, it's really about asset allocation. At the moment, you've got about 1.6 of net equity in investment properties and about 1.1 in share market across super and your ETF portfolio. If you put all your super into property, you're going to be heavily skewed towards property. And that's okay because you're 38. Well, it might be okay, I should say, because you're 38. You've got a long runway left ahead to sort of rebuild the share exposure again. But I guess all we need to do is look at the last few years in terms of returns. Even if we look at compared geared versus ungeared returns, so geared property versus ungeared shares are still holding their own, right? And in a lot of situations, particularly those investing in Melbourne, but in a lot of situations, the share market's actually performing better. I look at Europe as a geographical exposure in calendar 25, or at least the last 12 months. That might include January. It's returned, I think, 35%. That's not bad, right? And they're going to have good and bad times, both asset classes, of course. But moving too far away from an equal asset allocation, particularly since you've already accumulated a substantial amount of assets, doesn't make a lot of sense to me, because there's pros and cons. So in both. So I just don't think it's necessary. I think you're going to achieve your goals in terms of upgrade your home and fund retirement without needing to add additional gearing. And I think it then skews you too far into property in order to do it. But I will acknowledge that I could make an equal case for doing it in terms of, well, here's the numbers and here's the potential outcomes. It will generate more wealth, but it will generate more wealth by the time you're 60, because that's when you can access super. It doesn't necessarily help you achieve your goal of upgrading your home. Which takes me full circle. What would I do if I was in your shoes? Well, the answer is not debt reduction or putting money in offset account, because you're 38 and you've got no non-tax deductible debt. So I just don't think not investing is the right answer. I'd leave my super where it is, particularly if it's performing well, as I said. I'd monitor those 3 investment properties. Assuming you're happy with the current returns, I'd leave them as is. You've got 200,000 in offset against the investment properties. That's enough, I think, in terms of liquidity, and give yourself some headroom, all those sorts of things. I think I'd put it into ETFs. I wouldn't put a salary sacrifice into super just because you're 38. So you're still 22 years of being locked away. I just wouldn't do it, even though there's some tax benefits there. And the tax benefits of salary sacrificing for someone that's earning 125,000, they're there, but they're not going to move the dial that much. Whereas I think that if you keep investing in ETFs and in 5 years' time, you look at your borrowing capacity and then think, okay, well, one of these properties I'm going to sell because I'm not enamored by its performance. And you might be more inclined to do that if your share portfolio has, improved in terms of value, partly because of returns and partly because of contributions. So you might be more inclined to then go and borrow that money, knowing that, hey, our asset base continues to compound. And really, you do want compounding. You want those growth assets. When it comes time then to do the upgrade, of course, that's when you can put all your surplus cash flow towards repaying debt at that time, as well as taking that money from the investment offset accounts. So, Sam, I hope that answers your question and gives you some context for it. Okay, I'm going to leave it there today until next week. Bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.